The primary financial event discussed is the impact of President Donald Trump's One Big Beautiful Bill, OBBB, on clean energy projects, particularly those involving tribal nations. This legislative change has resulted in the reduction of incentives such as wind and solar tax credits and clean energy grants, creating significant challenges for renewable energy initiatives. Key entities involved include the Environmental Protection Agency, EPA, the Alliance for Tribal Clean Energy, and various tribal nations such as the Cheyenne River Sioux Tribe. The bill's passage has altered the financial landscape for these projects, with many now facing uncertain futures due to the potential termination of programs like Solar for All. The context of this development is crucial, as it comes at a time when tribal nations are increasingly seeking energy sovereignty and economic development through clean energy projects. The reduction in federal support has forced tribes to explore alternative funding sources, including philanthropy and conventional financing, to continue their projects. The potential impact is significant, with projects at risk of stalling or being restructured to comply with new federal guidelines. The situation underscores the broader challenges faced by the renewable energy sector under the current administration, highlighting the need for tribes to build internal capacity to manage their energy resources independently. This shift could have long-term implications for tribal economic development and environmental sustainability efforts.
Oil prices saw a modest rise as markets anticipated peace talks between the United States and Russia regarding the conflict in Ukraine, scheduled for August 15 in Alaska between U.S. President Donald Trump and Russian President Vladimir Putin. Brent crude futures increased by 0.6% to $66.96 a barrel, while West Texas Intermediate crude futures rose by 0.6% to $64.26. The potential geopolitical shifts have heightened market focus, with the U.S. hinting at tightening sanctions on Russia if an agreement is not reached, potentially affecting global oil supply. UBS has revised its year-end Brent crude forecast downward to $62 per barrel, citing increased supply from South America and steady output from sanctioned countries. In financial markets, European shares extended gains, with the Pan-European Stocks 600 index rising 0.3%, driven by optimism over a potential peace deal in Ukraine and diplomatic support for Ukrainian President Volodymyr Zelensky from Europe and NATO. However, German defense companies saw declines in their share prices amid peace deal hopes, with Rheinmetall, Rank, and Hensoldt experiencing notable drops. In contrast, Saudi Arabia's Tadawul All-Share Index fell by 0.99%, with the parallel market, NOMU, also down by 0.81%. Despite the downturn, Flynas Company was a top performer with a 3.48% stock price increase, although it reported a significant net loss due to IPO-related expenses. In other corporate news, Danish wind farm developer Ørsted's shares fell by 22%, following a 60 billion crown rights issue linked to challenges in the U.S. offshore wind market. Northern Data's stock also declined nearly 3% amid speculation of a $1.17 billion acquisition offer from U.S.-based Rumble. Investors are also closely watching upcoming U.S. inflation data and tariff discussions, which could further influence market dynamics.
ARK Investment Management's latest Big Ideas report highlights the potential of autonomous vehicles to transform the ride-hailing industry into a $10 trillion market. Tesla, a leader in self-driving car development, recently tested its autonomous ride-hailing service, Cybercab, in the U.S. However, Uber Technologies might emerge as a more significant player in this space due to its extensive ride-hailing network. With 180 million monthly users, Uber provides a ready platform for companies developing autonomous technologies, positioning itself as a crucial partner in the autonomous revolution. Uber's infrastructure and experience in managing ride-hailing services give it a competitive edge. The company already collaborates with 20 autonomous vehicle developers, including Alphabet's Waymo and China's Baidu, enhancing its market presence. In contrast, Tesla's full self-driving software is not yet approved for unsupervised use, limiting its immediate impact in the autonomous ride-hailing market. Financially, Uber presents a more attractive investment opportunity, with a lower price-to-sales ratio of 4.2 compared to Tesla's 12.4, and a price-to-earnings ratio of 15.8 versus Tesla's 186.3. As Uber's profits grow and Tesla faces shrinking EV sales, Uber could be a strategic choice for investors looking to capitalize on the burgeoning autonomous vehicle industry.
The US dollar continued its decline on Monday, falling by 0.2% to 98.073, as markets anticipate July's Consumer Price Index (CPI) data and the possibility of a 90-day extension to the US-China tariff truce. This decline follows last week's 0.4% drop and is influenced by a risk on sentiment among investors. Concurrently, the dollar weakened against the yen, trading at 147.46 during a Japanese market holiday. In contrast, cryptocurrency markets experienced a surge, with Bitcoin rising by 3% to $121,909.06, driven by a new executive order from President Donald Trump allowing cryptocurrencies in U.S. retirement accounts, signaling a regulatory shift. Ethereum also rose by 2.1% to $4,307.25, its highest since December 2021. The financial markets are poised for a dynamic week, with key U.S. economic data releases expected to impact the dollar index, gold, oil, and Bitcoin. The dollar index is currently trading within a range, with potential resistance at 100.2 and support at 97.2. Strong economic data could strengthen the dollar, while weaker data might push it lower. Meanwhile, gold and oil prices are also expected to react to the U.S. data outcomes. In Asia, China and Hong Kong stocks made modest gains ahead of the U.S.-China tariff deadline, with the Shanghai Composite Index rising by 0.5% and the blue-chip CSI 300 Index by 0.6%. Optimism about trade negotiations, despite deflationary pressures in China, contributed to these increases. The tech sector, along with liquor and eye-related stocks, led the gains. Lithium producers Tianqi and Ganfeng saw significant share price increases following CATL's suspension of operations at a major lithium mine. Investors are also awaiting earnings reports from major Chinese tech firms, which could further influence market dynamics. Overall, regional markets showed resilience, with the MSCI Asia ex-Japan Index up 0.30% and Japan's Nikkei Index rising 1.85%.
Palantir Technologies, a prominent player in the AI and analytics space, has experienced a significant surge in its stock price, rising nearly 600% over the past year. The company, which provides software and analytics solutions to large enterprises and the U.S. government, has seen remarkable business growth, with revenue increasing by 48% in the last quarter to reach an annualized $4 billion. Despite these impressive figures, Wall Street analysts have set a price target of $150, suggesting a potential 17% decline from its current trading price of $180 as of August 7th. The primary concern surrounding Palantir's valuation is its limited addressable market, which is confined to large organizations and the U.S. government and its allies. This constraint raises questions about the sustainability of its current market cap, which is significantly higher than that of comparable companies like Salesforce, despite generating only a fraction of the revenue. With a price-to-sales ratio exceeding 100, Palantir's valuation appears stretched, and even under optimistic growth scenarios, the company's price-to-earnings ratio suggests limited potential for positive returns. Investors are advised to consider selling or reducing their holdings in Palantir to mitigate potential downside risks.
The imposition of a 50% tariff on Indian goods by former U.S. President Donald Trump has led to significant repercussions in India, sparking calls for boycotts against American companies such as McDonald's, Coca-Cola, Amazon, and Apple. This movement is driven by business leaders and supporters of Indian Prime Minister Narendra Modi, who advocate for economic self-reliance and a shift towards purchasing local products. The tariffs have strained diplomatic and trade relations between New Delhi and Washington, with anti-American sentiment rising as a result. In response to the tariffs, Indian banks have intensified scrutiny on loan applications from exporters, particularly in the textile, gem, and jewelry sectors, which are heavily dependent on the U.S. market. Exporters are exploring strategies such as market diversification, production shifts, and potential acquisitions in the U.S. to mitigate the impact of the tariffs. The Indian government, led by Commerce Minister Piyush Goyal, is actively engaging with exporters to assess the impact and is considering support measures like financial relief and duty drawbacks. Despite the boycott calls and financial pressures, there is no immediate evidence of a decline in sales for American brands in India, which remains a crucial market due to its large base of affluent consumers. Meanwhile, Indian technology firms continue to thrive globally, with companies like TCS and Infosys playing significant roles in the international market. The ongoing tensions highlight the complex interplay between global trade policies and nationalistic economic strategies, with potential long-term implications for both U.S. companies operating in India and the broader bilateral relationship.
A significant shift in the European bond market landscape has seen former debt crisis nations Italy, Spain, Ireland, Portugal, and Greece emerge as favorable investment options, rivaling the traditionally dominant economies of Germany and France. This change comes in the wake of a robust post-pandemic economic recovery in these peripheral countries, coupled with a broader stabilization of euro area bonds. Investment strategists like Guillermo Felices of PGIM Fixed Income highlight the transformation of these nations from financial pariahs during the 2011 debt crisis to top picks for investors seeking alternatives to U.S. assets, which have been affected by policy uncertainties and fiscal concerns. Spain, in particular, stands out with projected growth of 2.5% for the year, significantly outpacing the Eurozone average. The appeal of these bonds is further bolstered by Germany's policy shift away from fiscal austerity, which, despite being a growth catalyst, has led to increased caution and dampened demand for German bonds. As a result, the yield differential between French and Italian bonds has narrowed to its lowest in 2 decades, reflecting a shift in investor sentiment, while the rally in peripheral bonds means potential returns are less attractive than before. The ongoing fiscal responsibility and economic stability in these regions continue to draw interest from global investors, suggesting sustained outperformance barring any major economic disruptions.
OpenAI's launch of GPT-5, its latest generative AI model, is poised to significantly influence the IT services sector, according to Kotak Securities. While the model promises to enhance reasoning and coding capabilities, leading to greater adoption of generative AI in software development, it also poses a risk of revenue deflation for IT service providers. The brokerage firm highlights that enterprises are increasingly focusing on integrating generative AI into their operations, which could initially result in reduced demand for traditional IT services. However, this shift is expected to open up new avenues in cloud and data foundation, legacy system modernization, and AI-driven business solutions. Despite the potential for short-term revenue impact, Kotak Securities suggests that the adoption of GPT-5 will eventually create new opportunities that could offset initial losses. The firm anticipates a temporary net headwind for Indian IT companies, projecting a 2 to 3% impact on revenue growth over the next 2 to 3 years. This outlook reflects a transitional phase where savings from enhanced software development are reinvested into emerging AI-driven opportunities. As enterprises continue to explore the productivity benefits of generative AI, IT service providers may need to adapt their strategies to capitalize on these evolving market dynamics.
The International Monetary Fund, IMF, projects that global inflation will remain significantly above the ideal 2% target in many regions through 2025, despite some countries returning to target levels. According to Statista's Katarina Buchholz, while 30 countries, particularly in Western Europe, are expected to stabilize their inflation rates by 2025, regions such as Africa, the Americas, Asia, and Oceania will continue experiencing elevated inflation. The ongoing conflict in Ukraine and the aftermath of the COVID-19 pandemic, which disrupted global supply chains, are key contributors to these persistent inflationary pressures. Developed countries saw inflation rates of 7.3% in 2022, while developing nations experienced 9.5%. By 2025, these rates are expected to decrease to 2.5% and 5.5% respectively. However, regions like emerging Europe, Sub-Saharan Africa, and the Middle East and Central Asia are projected to have higher inflation rates, driven by factors such as economic growth in developing nations and regional conflicts. Countries facing extreme economic challenges, such as Venezuela, Sudan, and Zimbabwe, are predicted to suffer from inflation rates ranging from 43% to 180%. Meanwhile, nations like Turkey and Argentina continue to grapple with inflation rates exceeding 35% annually. These trends highlight the uneven recovery from pandemic-induced economic disruptions and the geopolitical tensions exacerbating inflationary pressures globally.
Tempus AI, Inc. is currently embroiled in a class action lawsuit filed by Robbins, Geller, Redman, and Dowd LLP, with an investor deadline for seeking lead plaintiff status set for August 12, 2025. The lawsuit, under Schaus v. Tempus AI, Inc., accuses the company and certain executives of violating the Securities Exchange Act of 1934 by allegedly inflating contract values and engaging in questionable financial practices, including misleading statements about partnerships and unethical billing at Ambry Genetics Corporation, a company it acquired. These issues were brought to light following a critical report by Spruce Point Capital Management, LLC, which led to a significant drop of over 19% in Tempus AI's stock price. The legal action highlights potential vulnerabilities in Tempus AI's financial reporting and operational integrity, raising concerns about its future revenue prospects and investor confidence. The lawsuit could also impact the company's strategic partnerships with major firms like SoftBank and AstraZeneca. Robbins, Geller, Redman, and Dowd LLP, known for its expertise in securities litigation, is leading the case, underscoring the seriousness of the allegations. Investors are encouraged to consider the implications of these allegations on their investments and the broader market sentiment towards similar technology companies.